Hello, everyone, and welcome to another Coffee with Carl. My name is Carl Zellner. I'm one of the attorneys with Anderson Business Advisors, and today we're going to talk a little bit about common joint venture issues. So if you didn't know what that JV stand for, it's joint venture. Joint ventures are awesome. Usually it's a good mix between somebody who may have some money and another person who has time, or a blend of those two issues. A lot of the time, I'm one of the attorneys that works on the Platinum questions in our Platinum portal as well, and a lot of the issues that we come across are joint venture issues. There's some things we need to consider when we go into a joint venture just to make sure that we're doing things correctly. In most cases, what I'll say is the problems I see is number one, of a mistake of law, meaning a misinterpretation of what's being created when you create a joint venture, or number two, it's a agreement produced by the general public, or as we call them, laymen, and they're missing a lot of the terms we'd want to be addressed within that joint venture agreement. So normally when we set up a joint venture at Anderson, we're setting it up in an LLC, and each of the partners is the member or owner of the LLC as well as managers. So it gives them ownership and control over the project. That way everybody sort of gets a fair say, as well as if something goes wrong on the project and somebody tries to sue you for what went wrong on that project, ultimately your liability is limited to what's inside of that box. So meaning usually it's just the property and maybe some small amounts of cash accounts until the project is done. Now, some of the most common issues we run into, like I mentioned, was the mistake of law side, which you'll see a lot of times out there is that people do what I term as paper joint ventures, meaning there's some agreement put in place in contract form that says you agree to share the profits and losses of the business, or say if it's a flip, of the flip, at whatever percentage you and your partner dictate. Now, that term is important, but the problem you're creating is without an LLC wrapped around it, inadvertently what you've done is create a general partnership. Even if it notes it in the documents, some plaintiff's attorney is going to argue that you actually created a general partnership. And the problem with general partnerships, meaning partnerships not happening in an LLC, is that each general partner has unlimited liability. So if that partnership does not have the assets to cover any judgment, then the plaintiff can go after the individuals, and the individuals have unlimited liability. So in essence, you've just kind of drawn a line straight to your personal assets if you're doing one of these paper joint ventures. So we don't like those. We want to use a joint venture LLC. And then we're also going to say you should also have a joint venture agreement in there as well. Another thing that folks miss a lot when they're doing these type of activities is in that joint venture agreement discussing what happens if there is a loss on the project. Of course, nobody goes into business expecting to take a loss or goes into a project expecting to take a loss, but it's good to address what happens if a loss takes place. Now, we really run into issues, and when you get over, say, maybe 3 partners in a deal, number one is the margins. The more partners you have, usually the margins get smaller and smaller on the deal is an issue. Number two is, especially when we're talking real estate, if you have a hard money loan on the property and then you have a couple of gap funders, say if you make enough on the project to cover the hard money loan, but not enough to pay both gap funders, then you can be in a real hornet's nest. So what we do is we include provisions within the documents that say and state specifically the progression of who gets paid out what in the case the project takes a loss or there's only enough money to pay off a couple of partners. Just as a general kind of FYI, it usually goes from debt gets paid out first, capital accounts, then profit is split. So you can see if you have a log jam at any of those levels where the rest of the partners may have some issues coming into there. So we do have a ton more information on joint ventures. We also do have a joint venture agreement that we have in place that is available to any of our current clients in our Platinum form section in the Platinum portal. Once again, please keep enjoying all of our free content. If you want or need a consultation, please give us a call or click on or go to our website and we'll schedule you for a call. It's andersonadvisors.com. Until next time, this is Coffee with Carl. It was a pleasure seeing you, and we'll catch you on the next episode. Thanks. you.